guys. I mean, Paul, we're at these record levels, but you say it's time to get defensive because the overall S&P is expensive, too many rate cuts priced in, and earnings are overall going to disappoint?
Yeah, I mean, we've been defensive for a little while now. I mean, we're still neutral on tech. We want our investors to get the full benefit of the upside in the market, but it's just too much. A lot of earnings priced in, maybe earnings fully priced. A lot of optimism about the Fed, maybe overdone, and the economy still slowing. Look, earnings have beaten so far for the fourth quarter 6% over forecasts. That's an improvement over Q3, but less than Q2 and Q1 of last year. So the trend in earnings clearly down. We would just be a little bit defensive here.
Okay, and Mimi, you seem to agree that the S&P is too expensive, but here's my pushback on that. The equal-weighted S&P isn't that expensive at all, and large-cap tech has this AI tailwind that we've been seeing in NVIDIA. So isn't it possible there's a good reason why stocks like NVIDIA are expensive and that smaller names in the S&P are cheaper for an equally good reason?
Yeah, I think you make a good point with the rest of the market not being as stretched. One way that we like to address that is we have allocations to small and mid cap, and you can see today the Russell performing well. That's a healthy thing to see a greater amount of breadth, which we have seen in the past couple months. So that's kind of how we're addressing some of the richness of this magnificent seven.
Paul, I realize that yields came off a little bit today, but we had a big run up last week. And my question on this is, why is risk appetite so robust in the face of yields and money market rates backing up in general since the start of the year?
Well, I mean, rates have backed up just a little bit, but you've still got the Treasury very supportive of the short end of the curve. And then what that's doing is to create a lot of demand, a lot more demand than there is supply for longer term Treasury notes. That's pushing longer term yields lower. And if you have a really long duration bet on AI or anything that's tech related, what would you like best is to have a really low discount factor to put against it. That's why we're neutral on the tech, but we would agree with Mimi. Here's the chance to really get into some things that are cheaper priced. We like industrials, we like healthcare, we like materials, and really we've just gotten back into energy. We think there's value there.
Yeah. Mimi, just to dig a little deeper into the earnings piece of this, I mean, if the market is arguably too rich, or we'll say maybe fairly valued, I mean, how much is going to hinge on earnings growth being realized in a robust way this year? And I ask that realizing that obviously the macro and this idea of a Fed back in play are going to be in focus as well.
Yeah, we agree. There's a lot priced in. The bar is high. And I would say that the landing strip is fairly narrow to land the plane perfectly well. We probably have higher odds of recession penciled in than the market does, for certain.